there's a lot of interconnectivity between banks and credit reporting.
To kind of keep to the theme of what we've been talking about, alternative data and how it's being used to enhance lending today. But we've been talking a lot, there's been a lot of good conversation of solutions, policy that needs to go into it. But we want to talk to actual lenders and see how they use it, or talk about it from a profitability point of view, because it's all about the money. How much can they make at the end of the day? But before we go there, just a bit about credit info. So credit info, all the sorts of things that have been spoken about over the course of this conference, that has been a difficulty in being able to enhance lending in these markets. Our focus is around 3 general areas when it comes to lending or to our services and what we offer. So data is always our core and the basis of everything that we do. So how do we use data to be able to enable lenders to be able to know who to lend to and do so profitably? We then, using that data, try and see how we can draw insights. Quite a number of things that were spoken about earlier on, by the likes of Finport. How do you build scores to be able to identify these people and so on and so forth? And then the last bit is our software, delivering those insights. What systems do we help the lenders use to be able to deliver on those insights? But let's get into today's discussion. So, in any given situation, enhancing lending using alternative data, it all comes down to one thing: profitability. Now, what I have here is a slide which I'll probably leave up for the talk as we talk through the whole segment, because this is actually a mock-up of an actual lender and their profitability. So you look at what their interest income is and the different points or costs that go into it and their final profit that they make. Now, when we talk about enhancing lending and making lending more profitable, how do we use alternative data for lending, identifying our customers, identifying market segments that we could lend to, how do we improve on our collections, all sorts of things so that we can actually increase on the bottom line for that lender. So I have a panel, and I'll call them as they come in, of different speakers from the banking industry.
That's your normal retails. And let me also into digital lending. Thank you.
Alright, can I go ahead? Alright, good morning, good afternoon everyone. I'm Philip Kishangi. Kamau already introduced KCB Group, so I won't go into the detail, but we're a regional banking entity, regional group entity that operates in about 8 countries. So I sit in, when I head the bank's group's lending risk department, having a technology background that is managing risk, basically, the risk spectrum and the second line of defense as far as management of credit risk is concerned. However, we also play a huge role in development of tools, credit scoring and other rating that supports the growth of the group's banking entities across those countries that we mentioned earlier. Thank you.
Good afternoon, everyone. My name is Michael Nyaga. As Kamau has introduced me, I take care of digital lending initiatives within Equity Group. As a group, we are cut across about 6 countries in Africa. Of course, with ambitious targets to go into about 25 countries in the continent. So basically what I do is take care of various verticals within the digital lending space that cut across from technology, business interventions, process refinement, product development, and that's largely what it is. And within that spectrum, given that we also looking at lending and exposure, then tapping into different kind of data sets are critical that we have it, whether it's coming from aggregators or coming from individual companies that we can interface with. That's largely what I take care of and happy to hear.
Good afternoon, everyone. My name is Monyi Ndika. I serve as the GM of the Tala business in Kenya. So Tala is headquartered in Santa Monica, California, and we operate across the market. credit is actually, I trained as an economist, but many years ago, fell in love with tech. And so over the last 18 years, we've been through the tech industry in Kenya. But the bulk of it is in the fintech space, and works with a couple of fintechs, rolling out products across multiple markets in Africa. In terms of Tala, formed in 2014, is a pioneer digital lender in this market. So, save for what you see the legacy banking doing in digital lending, what you call independent digital lenders. So, Tala has been a pioneer in that space for the last 8 years. We believe, we think we're the largest in the country, separate from what the banking sector is doing. And right now, 8 years later, we are looking at a market that we sort of consider nearing saturation. And therefore, we're looking at how can we then sort of transform into a fully fintech company and looking at financial services more broadly, but not just as a digital company. So we'll speak more about that as we go. Glad to be here.
Muni. But I'll ask Adam this question. So when it comes to lending profitably and understanding that particularly in East Africa, you are a credit-only microfinance. So access to funds to lend could be expensive, I don't know, you will tell us. But obviously how you assess your customers to ensure that you can maximize what you get, because your cost of funds is a key aspect. Growth is also a key KPI because you want to grow, but you also want to be able to lend and do so in an affordable way while managing risk. How do you do it, and how? And just tell us more about it and what it is that you do as, let's say.
Starting from what you just said, indicated, first of all, for you to be able to lend, you need to know the source of the funds that you're going to deploy. And getting them in an affordable manner enables you then to aggregate the money more affordably. Speaking to about just looking at the credit only, for example, the type of businesses that don't mobilize deposits, the starting point is getting a partner that first of all understands your business and your business model well, and how the dynamics in that industry play well. For example, I'll give you a quick example. If I go to KCB and borrow, and they give me at a certain rate, it will be very good, for example, for them to understand how will the market affect the whole market affect the same. For example, as an aggregator of my money. In that, for example, when banks are increasing their rates, you will see micro lenders will actually be reducing their rates because of trying to defend their territory. Because the increased appetite at the bank and the commercial lenders at the banks makes it more difficult for you as a lender to retain your clients. So you find you going the opposite in terms of your pricing. So then that means your lender must understand you first of all as a credit aggregator. Fast forward, when it comes down to your customers, to make sure that you're lending and getting it profitably, the first level is risk assessment and your risk management. If you look at your risk assessment, you are assessing the customer and trying to determine what will make this customer, first of all, pay me back my money. Then you will also look at it and say, what are the chances of the customer not being able to pay? And in that, you analyze a lot of data. We talked about a lot of data today. Traditional lending is kind of becoming a little bit boring and old. You initially would rely on your 5 P's, the people, the process, the paperwork, but all that now is being the flash of the button just is being taken away by technology. So understanding your customer, if you have enough data, one of the speakers earlier in the morning talked about you collect the data, it doesn't matter how you use it. That's very important. So if you have enough data, because with the use of tech, makes it easier for you then to be able to know how do I actually do risk increase pricing. We try to use that to make it cheaper for the customer. And then looking at the management element of it, over time, if you are looking at an MSME, and you will need to understand the business, how they're going, the cycles, and manage that relationship. So that as you go through the journey, your lifetime profitability of that money is actually guaranteed by you being able to get it back and managing it efficiently.
So that's a good point. So, as you said, the traditional lending has gone boring, so people are moving more to digital lending. So that also means that data, to a certain extent, has been democratized. And once you move from the traditional to digital, it means that you do not necessarily own your customer anymore. And this customer has access to credit everywhere. So, Philip, maybe tell us from a banking perspective, knowing that these individuals are multi-banked, multi-borrowed, how do you then assess this customer, ensure that they're profitable, or retain this customer from a banking perspective?
The shape changes a little bit because from what you're calling traditional banking, you already have a set that you can target and utilizing the internal data of customer behavior and so on. But the challenge then comes in where you have to grow, where you have to compete, where you have to remain profitable, you have to scale even further. And that's where, going back to the theme of today, data, alternative data, comes into play. Banks can no longer then sit back and rely on what you have internally. Just going back to what I think Dr. Tijongo had mentioned earlier, central bank issued guidelines saying going forward, banks must utilize credit scoring, must utilize data from credit bureaus. So you begin to deep into that, and it's this data then that banks process, whether fully digested data in the form of bureau or bureau score from one of the bureaus, or raw data that you ingest and apply to your own processes to run, whether it's machine learning or other methodologies to come up with better insights on customers, which then feeds down into the chain. Then you can better profile customers, better price these customers. That same kind of banking sector charter that Dr. Tijongo talked about insists on fairness, and it's this data that allows you, from a pricing perspective, to be fair to customers, price them according to your risk, according to their risk levels, and manage as well from your income or then profitability, determining it using your internal risk calculator exactly where to set that bank. Now, going further, and we've seen a lot of that getting into this space in recent years, and banks have to seek options even further outside of bureaus as well, alternative sources of data. Several banks have partnered, whether with telcos or other organizations that are aggregating other forms of alternative data, whether it's mobile data, whether it's device data, and so on. So, attempting to use the same to enrich our processes from a risk profiling, from a probability of default computation perspective, so we can better offer and services and compete and stop being referred to as a traditional or legacy.
Because that is important to us. So when you look at your, I know we're talking about lending, big, borrowing, changing into digital, but even if you look at the digital lending products as they are today, is money that is dispersed into a person. So nobody really follows up what happens to that. Probably a person knows, but the lender doesn't. So it was all about connecting the dots, understanding how the customers use these funds so that we can better serve them. And what we did realize, number one, is there's a very thin line between consumer lending and MSME lending. Because most of the guys that borrow from us use that money for business. That is what appears as the highest use case. So you find then that I borrow as an individual, but the use case is to pump money into my small business. So that is number one. Number two, what we found out as well is people borrow a lot for utilities. Yeah, to pay your bills. And it's your usual KPLC, water, DSTV, and whatever it is. So interesting that digital lending is financing sort of your lifestyle. And so when you start looking at these insights, then you start asking yourself, from a product market fit perspective, are you actually addressing the challenges the customers are facing? So what this report is telling us is, how can we adjust our products to fit the kind of use cases that we are seeing? And even speaking to the customers directly, so I'll give one example where we went into the markets and spoke to the mom bloggers and asked them, how would you like your digital product to work, digital learning product to work? And very interesting is that they say, so for example, about Freezer, they say, we love Freezer. When you ask them how much is Freezer, they don't know. They just tell you it's accessible. I have it on. But we hate the fact that they auto debit from my wallet. I want to have control of how I repay. But what do we do as an industry when day 30 reaches, you call, you must pay me now. But the lady in the market is saying, hey, I want to use this money as a revolving fund. So that when I get my stock, I sell. Then I buy more stock, I sell. Grow my margins, then I can repay you. So do not limit me to the 30 days. When you look at the digital lending products in the market, most of them are 30 days. So you ask yourself, who decided that? It is us who decided that. It's not what the customer wants. So then you start thinking things like, loan tenures, how do you then adjust that? Should they be flexible? Should the customer be allowed to choose when to pay? You think of the use cases like I've talked about. You also talk about the limits. Because today, and what we've seen at Tala is we lose a huge chunk of our customers, not because they're not credible, it's the offer that we give. So I've come in, I want 20,000 bob, I get 5. Like, I'm not interested. So we find people, a lot of people who come in, apply, but not disposable. Just because the product does not fit their need at that particular time. So the question is, how do we connect them? So for example, if I wanted 5,000 shillings to pay for my electricity, and I come to Tala, Tala doesn't know that I want to pay for electricity. So then we don't know beforehand that that person needs 5,000 shillings. So what we are doing now is connecting the product to the use case directly. So beforehand, you already know what expectation you have from the customer. And because you can connect those dots and you can see how the money flows, then you make a better decision and therefore keep the customer the limit that they need. So for me, those are the things that really stood out. The challenge for all of us is how we then connect all those dots. And in there, somewhere in there, generate a lot of data that we can use to continue scoring and regulating the customers.
That's very interesting, because I don't know if you can
regulations and how much it slows, how quickly you can adopt all these and drive profitability. And because the regulations are always kind of catching up with driving digitization and all that, and accessing new data points. And they really vary from one country to another. Some countries are insisting on data sovereignty, so you can't leverage cloud solutions, for example, to drive efficiencies. In some countries, how much you can even go in terms of accessing other technological solutions, again, like cloud, is not even mandated, or it's something that is frowned upon from a regulatory perspective. Yeah? So variables around, how much does regulations slow down your ability to tap into new bases to drive profitability? And maybe what are your thoughts around what needs to happen to enable quite a vibrant regulatory space that then would be in sync with what you're trying to do?
Will probably borrow simultaneously, and quite a bit of them will be doing loan stacking. While data submission, and particularly to the bureau, or if you think about any other data depository, does not follow the same level of velocity today in a country like Kenya. Do you then feel that this challenge leaves you blind-spotted when you're making a decision to give me a loan at the point, because you still also want to give me that to make a decision in microseconds and probably have done my application to 4 applications at the same time? So do you feel there is a challenge in terms of being blind-spotted there? And from a solution perspective, is it a consortium kind of solution that you see that would address that gap?
If not, why not? And looking at this market, what do you see to be the best approach to what do you feel is the best solution to approach that? My second question is to both Equity and KCB, Michael and Michelle. In the value chains, we see a lot of embedded credit today, where value providers, goods, services are giving credit, especially with access to debt. They're able to then engage their partners in credit. How are you trying to safeguard your opportunity and profitability even within that kind of environment?
She will answer that question in quite some detail later, but probably what I could comment on, the Hustler Fund, of course, was rolled out with support of several players, some of them in the banking sector. And I think today quite a bit has been disbursed. Public figures show upwards of 20 billion. How does it affect the product? I don't know what the other players would say. I'm not sure that they have seen any effect. Yeah. Not just because it's probably targeting a different kind of limit, different kind of customer segment and so on, but it's another play. I don't think the introduction of the second entrant to Tala, the branch or whatever, probably had the biggest dent. There's quite a bit of a slice in this market, and I'm sure, as Madam PS Honorable PS will allude to later, this was probably targeting segment of customers who may have been left out of these other lines of credit. Whether it's because they've defaulted in the past or do not have sufficient historical data to access whether it's Tala branch or a bank for borrowing. Have we seen an effect in terms of money out there? Of course, there's more money out there. Have we seen an effect in terms of performance of other products? Yet to see that, and I do not think it's something we're going to see very soon. But I think a proper answer will come later.
Maybe just to help in terms of rehabilitation. We have helped to rehabilitate the guys who are down there, who are lenders who have knocked out. So we cannot really say, oh, it has actually done, it's a positive input to the sector. Because when that customer now is able to go out there and continue selling, they're able to come and pay me what they were not able to pay. So I think it's a very big input into rehabilitation. All you need now to do is just to make sure that you're managing it, to rehabilitate, to make sure there's behavioral change in terms of those who are not paying. And there's a solution to that today. So I think look on application service and we resolve that, the issue of payments, paying back. But it's a positive input. It is not a competitor in terms of, because when you will tell you, possibly from your report, you've done 280 billion, I think, how many years since, on digital lending, was it in 7 years? Yeah, which is something, it tells you there is a big slice in the market, so I think it's a welcome competition.
The rollout of the Hustler Fund is probably, and its success is probably one of the biggest generators of usable credit data in a long time, because you've taken up, through the government's effort and guarantee, you've taken up, or you issued loans to essentially offered loans to every Kenyan. And you can, and as a result, then have been able to generate quite a bit of data that can be used going forward, for lending purposes. None of the non-bank lenders here will probably reveal their approval rates, but of 100 people that apply to a lending agency, probably, I don't know, 20, 30, 40, 50, I don't know the number, but that's the percentage probably that gets approved, and it's that segment then that you begin to generate data on that you can use to increase limits, to offer better products and so on. But the Hustler Fund, the government has actually come out and given every Kenyan, not given, but offered every Kenyan a loan, essentially generating training data, it's the biggest sampling exercise and generation of alternative, you can call it alternative data, that's taken place in ages. So from that end, I would tell you it's a humongous success. Thank you.
We have an acronym internally, we are calling VUCA environment. So we have volatile environment, uncertain, and a complex, and a very ambiguous kind of environment. So it speaks largely into the macro environment, and speaks largely into how you structure your tenures for your facilities, because that any customer who's in the MSME space is very gullible, so to speak, in terms of what happens in the macro environment, because there will be uncertainty. And that's why getting additional kind of information about their cycles speaks a lot because of how you structure their tenures. So they will always feel like whatever is happening will definitely impact on their cash flows and ultimately filter into those. So you have to find a way, and that's what largely IFRS 9 was largely trying to build, so that you couple what is happening in the macro environment and then filters in your lending models, and speaks also into what it segment the customers further and speaks into your tenants. But also, I think we need also to change the metrics of how we look at NPLs, especially when you're talking about short-term kind of facilities. The metrics of NPL is simple. Any loan is in arrears over the total loan book. But when you start going shorter term kind of facilities, the vintages speaks more, because then you start thinking about this cohort, how they repay over a period of time, and those metrics will not be the same. If assuming you're doing a 7-day loan and a 12-month loan, those are totally different segments. And you might start looking at even curtailing growth because you think the NPLs are shorter. So you always have a residual out of those customers of the cohorts that never paid. So those are things that also, I think, speaking to the regulators, that's something that we need to start thinking, even as we think about how do we bring in regulation into bringing more people across the various sectors of the economy to have visibility from a regulatory point of view.
Thank you, gentlemen. Asante sana. I'm sure there's still a lot more to buy.